Okay, here we are at week 3, lecture 5, cash flow statement. We're going to be using the indirect method of figuring out the cash flow. I dug this stat up from someplace, don't know where, but 97% of the companies who do the cash flow statement use the indirect method. Have no idea where that name and that number came from, and I have never personally encountered a company that does the direct method. The direct method is basically going through each ledger account line by line and seeing whether there was an increase or a decrease in the account and whether that affected cash. Now, an income statement, for instance, is usually a compressed statement of all the expenses of a company, because some of them are grouped together. We might have general office expenses, so they tend to be shorter so they can fit on one page. Same way with the balance sheet. But the good thing is we can use the income statement and the balance sheet as they stand and figure out what our cash flow, where it came from and where it went. Okay. Because of that, it's a derived statement, and I call it sometimes a fake statement. It's kind of made up, but it's based on the income and the balance sheet. Okay, so it's very valid in that sense and very useful. Now, for the example we're using, the net profit is $110,500 and the amortization expense is $54,000. Just going to use these two numbers. There's no point putting a whole income statement in a slide. Those are the only two numbers we're going to use, so I just pulled them out, and now we're going to have a look at the balance sheet. Okay, on our balance sheet, to construct the operations portion of the cash flow statement, we've already got the income and the amortization. We're going to look at GICs. Those are current accounts, accounts receivable, inventory, and prepaid expenses. Okay, we're not looking at the cash. The cash is something we're trying to figure out, where it came to and from and went and all that sort of stuff. Okay, so the GICs, no change. Don't have to worry about those. Accounts receivable went up $30,000. Okay. Accounts receivable went up $30,000. Inventory went up $20,000. Prepaid expenses went down $10,000. So there we've got our current accounts, current assets. We're not going to look at the long-term assets just yet. We're just looking at the current, and those are what go into the operations portion of our cash flow statement. Okay, following up with some words to go along with what I was talking about. GICs, no change. Accounts receivable up 30, inventory up 20, prepaids down 10. Okay, so in terms of what happened to the cash, well, nothing happened when the GICs didn't change, cash didn't change. Accounts receivable is up $30,000, so our cash is down 30. Think of it in terms of what our customers have. If at the end of one year they've only got $170,000, then at the end of the next year they've got $200,000. Really, they've taken our money, or they have our money, and as a result, our cash has gone down. Same with inventory. We've had to go out and buy inventory. We bought $20,000 more than we did the year before. That's cash down. We had to pay for that inventory. Prepaids, which may be lawyers' bills. Sometimes they'll work for us on what's called contingency. They bill us first, then, or not contingency, but a retainer. They bill us first, do the work, and then we have other companies that do that sort of thing. Maybe we have to pay half down before the work starts, and sometimes we have to pay all of our insurance up front, depending on the situation. At the end of 2013, our prepaids were down $10,000, which means our cash went up $10,000. Okay, so we've got something going on here. Basically, if our assets go up, our cash goes down. That's a pretty good rule. And if our assets go down, our cash goes up. So just think of it that way. It's kind of the assets behave in an opposite manner to the cash, or the cash behaves in an opposite manner to the assets, depending on how you want to look at it. Okay, moving on to the other part of our non-cash working capital. Remember, working capital deals with our current accounts. We're looking at accounts payable and notes payable. Our accounts payable went up $8,000 and our notes payable went up $10,000. Now, realize that in 2012, those $115,000 in notes payable would have been all paid off in 2013. And what happened in 2013? We went out and got some more, $125,000 more. And as a result, the balance difference is $10,000. We got more notes payable at the end of 2013 than we did at the end of 2012. Okay, we're still building our cash flows from operations. So our accounts payable up 8,000, notes payable up 10,000. What happened to the cash? Well, cash went up 8,000, cash went up 10,000. Accounts payable, that means we didn't pay some of our bills, we didn't pay some of our suppliers. As a result, we have $8,000 more in our pocket. Same idea with notes payable. We didn't pay some of our notes payable above and beyond what we didn't pay the year before, $10,000 more, so our cash went up $10,000. So here's another rule. If our liabilities go up, then our cash goes up. If our liabilities go down, our cash goes down. Okay, handy little rule to remember, and they work together in that sense. So in terms of the big picture for our statement of cash flows, our cash flow from operating activities, net profit 110, add back the amortization of 54, we got 164,500. Then we've got our working capital changes, which total $22,000 to the negative, so that means that $22,000 of cash went out the door. Okay, and cash provided, after all is said and done, from operating, from running our business, we still got an extra $142,500 in cash coming in the door. Okay, just to review our little rule here. Assets up, cash down, assets down, cash up. So that's on the asset side of the balance sheet. Liabilities up, cash up. Liabilities down, cash down. So if our liabilities go up, that means we've got somebody else's money, we've got a loan, or we haven't paid something. And if our liabilities go down, we've paid something. That's money out of our pocket, so cash goes down. Okay, and just to finish it off, our little graphic here for cash flow for operations, our net income plus our amortization, minus or plus our increase or decrease in current assets. Remember, the cash flow is going to be different on assets than it is on liabilities, and same idea for our liabilities. Add those up and we get our cash provided or used in operating activities. That's the end of our first good group on cash flow statement.